Hi, welcome to a video on inventory estimation techniques. Earlier, we examined techniques to simplify the estimation of LIFO inventory given FIFO inventory. Now we're going to examine techniques to estimate total inventory values. These are applied by many huge companies. So in this video, we're going to speak in general about inventory estimation techniques. We will then do two particular cases, common instances. So for some companies, it is difficult or even impossible to physically count each unit of inventory. As a result, estimation techniques have been developed. Estimation techniques are also applied in interim reporting at times to avoid the cost of conducting physical inventory counts more than once per year. Two such techniques include the gross profit method and the retail inventory method. Remember, Target said in their annual report that they use the retail inventory method. Here's a little general information about both of these methods. The gross profit method. It's also known as the gross margin method. It relies on the relationship cost of goods available for sale equals cost of goods sold plus ending inventory. Remember, we have used that in our inventory studies because we have cost of goods available for sale, and we have the two places it could end up. Those units could have been sold, so cost of goods available for sale during the period, and the actual units available for sale during the period. They might have been sold, or they better be in ending inventory. Accounting records have beginning inventory, and they have the purchases. Thus, cost of goods available for sale is a known quantity. Of course, accounting records also track total sales. So cost of goods sold can be estimated by multiplying those total sales that we track by the gross profit percentage. We then calculate ending inventory as beginning inventory, known, plus the purchases, known, minus the cost of goods sold. Beginning inventory plus purchases is cost of goods available for sale minus ending inventory equals cost of goods sold. So if we just do your algebra here and add ending inventory to both sides and subtract cost of goods sold from both sides, and you will, so in other words, we're bringing cost of goods sold over here, ending inventory over there, and we're just mathematically rearranging to say beginning inventory plus purchases minus cost of goods sold equals ending inventory. And again, that is just an algebraic rewrite of the formula that you've become so comfortable with. Okay, so that's the gross profit method. In the next video, we will do an illustration of this. For now, we just illustrate the concept. Let's illustrate the concept of the retail inventory method. The retail inventory method is used by many large retailers. It's ideal for high volume retailers that sell many different items at relatively low unit prices. The principal benefit is that a physical count of inventory is not necessary. Most of these large companies do conduct one once per year for control purposes, though. Otherwise, companies just track purchases at cost and at retail prices. The cost refers to the purchase cost. The retail refers to the current selling prices. So the steps in the retail inventory method are track the purchases during the year at their cost and at the retail amounts. calculate cost of goods available for sale, which is the beginning inventory, known, plus those purchases, known. Calculate the cost to retail percentage, and then cost of goods available for sale at retail minus net sales is ending inventory at retail. We then multiply ending inventory at retail times that cost to retail percentage and subtract estimated inventory from cost of goods available for sale to estimate the cost of goods sold amount. Again, in the next videos, we will do illustrations of both the gross profit method and the retail inventory method. Okay, for the rest of this video, we're going to continue to speak about the concepts in general. So on the next page in your prepared notes that you printed down, we have our case for the gross profit method. We'll return to this. In the next page, you have our case for the retail inventory method. We'll return to this in the next video. For now, let me just say a couple things about other issues related to this topic. The gross profit and the retail inventory method can be used with any cost flow assumption, LIFO retail method, or even dollar value LIFO retail method. Dollar value LIFO retail is the most common of these. For example, you'll see, if you research it, you'll see that Costco uses dollar value LIFO retail. If you encounter these in your professional work or in preparation for the CPA exam, indeed, note that you are simply combining several skills that you've studied in this chapter. To that end, keep your book available as a great reference. There are also a plethora of explanatory videos available on the internet. You have all the background you need to understand, apply, and then master these techniques if you encounter them in any combination. So what I'm doing is giving you the most general forms, and then certain of your clients and companies will use them in conjunction with each other, and they'll be easy for you to pick up what is going on. Okay, so with that, thank you for your attention and your note-taking on this introductory video on inventory estimation techniques. Now, in the next video, we will see illustrations of them. Thank you again for your attention.